I am super excited to kick off what we're calling Vyzer's first top performer webinar. And just to give you all some background, we founded Vyzer with an objective to help people track and manage their wealth, especially around the more complicated types of investments in the private markets. Now, over the past 2 years since we launched Vyzer, we've helped more than 7,000 families track and manage more than $8 billion of assets. The vast majority of that, 70% in the private markets. And throughout this process, a lot of our clients have been asking us if we have any insight into who the top best operators are in their respective markets. Now we're finally at this point where we can confidently say, based on aggregated anonymous investment data, who these operators are. And based on that, we're starting to bring them to the table to present their deals. MAG Capital, which Neil and Drew are from, is one of these top performers. And they're here to talk about their third industrial fund. And they're going to talk about that. I'm not going to dive into any of that. But I will mention that Vyzer, as a side fund that we're putting together through SPV, is also investing in their industrial fund. This is SPV. It has no fees, no kickbacks. It's just simply a way for our own shareholders to participate in deals that we believe that are good. And we'll talk about this at the end, but all of our clients are also welcome to join this SPV. It's going to be at a lower minimum than doing directly through MAG. And there's no fees. There's no incentive here. It's just truly to give the most value. And we'll talk about towards the end of the call. It's also really important for me to say that we have nothing to gain from if you invest or not. No commissions to carry or anything from this deal. We purely want to bring as much value as we can to our users in the form of tracking, but also in terms of bringing the best deals to the table. And just for context for MAG, and we've sent this over our email as well, the reason we brought MAG specifically is because we have more than 50 people invested with you guys over the years. More than half of them have invested more than once. And, average returns are above 7%. And you guys are really great on updates, and K1s are on time. And overall, we think you guys are great operators, all right? And obviously we're also investing, and so we believe in that much. And so without further ado, and I'm going to head that over to you guys in a second, but I will say, if anyone who's on the call at the moment, if you have any questions, you have the chat open on the below, Q&A, whatever you guys feel comfortable asking. We're going to leave a lot of time for questions at the end as well. And without further ado, Drew, Neil, I'm going to hand it over to you guys and do your thing.
Sure. Thanks, Latan. I'm going to share my screen here. Does that look good?
Yep.
Excellent. Well, yeah, thanks for having us, Latan, and for the guests on the call. I've known Latan for many years now, and watched him build the Vyzer platform, and it's just been a very cool thing to see how it's grown. And a lot of our investors have used the platform, and really grateful for the opportunity to share with some of you who aren't familiar with us. I'm going to introduce myself and Neil. I am the VP of Capital Markets here at MAG Capital Partners. So alongside Neil, we are raising equity as well as bringing in debt for acquisitions. And Neil is a partner here. Neil, I'll let you introduce yourself.
Hi guys, Neil Walgren, partner at MAG Capital. Like Drew mentioned, Drew and I run capital markets, so really getting all the dollars in place for acquisitions. And just a little background on the firm. MAG Capital, founded by my two other partners, Dax Mitchell and Andrew G, in 2015. Both those guys are core real estate guys, about 30 years experience each in development, commercial brokerage, commercial appraisal, and really they are on the asset-facing side of the business, and Drew and I run the capital side.
And it goes without saying that you guys are brothers, all right?
Truly a coincidence. No.
I'll start with a quick disclaimer. This is a presentation and a summary of an investment offering, but investors should do their due diligence, and before investing, of course, should be reviewing our private placement memorandum, operating agreement, and all the associated docs with this before making any kind of decision, because those contain all the details. I'll kick us off here, Neil. Like Neil said, we were founded in 2015, and we're a commercial real estate investment firm that's really focused on single tenant, triple net lease industrial real estate throughout the US. We specialize in a sale leaseback structured acquisition model, and which we'll get into more a little bit here. But high points here today: we own and manage a little over $1 billion in assets. We've had a very successful run with a less than well below 1% annual tenant default rates. And we've gone full cycle on, we just went full cycle on one. I think we're at 34 at this point. So a little more than 150 million in full cycle deals and have realized an 18.1% IRR on average of those full cycle deals. And just to cover some bases here, we've never lost investor capital. We've never had capital calls, and we've never paused distributions. So it's been a great run for us, and you'll see kind of why our model works and why that's been successful for us. And the team, as good as our team is, has helped help us keep a really pristine track record.
Drew, I want to say one thing, because we review a lot of pitch decks, and if you go back one slide, and
Sure.
you wrote it in small letters, and I think it's important to emphasize. A lot of decks you'll see it says net investment IRR 18.1. Many times you'll see that, and it's on the deal level or the GP level. This is on the investor level, correct? And you wrote it small, like on small figures on the bottom left. It's important to emphasize whenever people go through decks. This is really important point. Okay, so yeah, net to investors, correct? The 18.1% IRR, correct?
Correct. Yeah, it's all fees and splits. It's direct to LP investors.
All right, cool.
Thank you for clarifying though, but because you're right. And we wanted to show exactly what investors have been seeing in those full cycle deals. So yeah, the team has grown even since this picture. Today, there's 24 of us that are full-time here. We're vertically integrated, so we have in-house capital management, in-house financial services, distributions. We are not typically co-sponsoring on deals with capital raisers. We typically are raising equity in-house. So that's a nice plus for investors as they talk to us. We are the team that's on the ground managing the assets. And so it goes even further into asset management, but as well as credit analysis, which we'll get into in a minute. But we have a very large team today. There's 4 credit analysts on our team that really take the brunt of that due diligence, which is a key part of our strategy. Here, a quick map just of assets we own. Industrial real estate. There's a lot of manufacturing in the Midwest, so we see a lot of opportunities there in Texas. But we are frankly agnostic as far as looking at deals. When we have a single tenant net leased industrial property that has a very long term, usually 15 to 20-year lease term, that affords us the ability to look at deals in other states and regions without needing boots on the ground, because these are very passive investments that don't need day-to-day lease-up activity. So quite the footprint here, and that allows us to cherry pick the best deals around the country. Neil, I'll hand it to you here.
Yeah, thanks, Drew. So introducing MAGCP Industrial Fund 3. This is really our third evolution on effectively bringing our industrial net lease strategy to the fund world. So for many years, probably too many years to be honest, about 7 or 8 years, we focused predominantly on industrial net leased investments, all single tenant, all light manufacturing tenants. And those we did them as standalone investments. And really an important thing to know is, with the single tenant nature, you end up having a bit of a binary occupancy profile. So either fully occupied and performing or fully empty. And so for that reason, really we decided to transition to the fund model. And the fund model effectively gives, the same strategy, same cash flow focus, but effectively provides a level of diversification where, even in the extremely unlikely event that we do have a tenant default, the cash flow is protected, the basis is protected, and most importantly, capital is protected. So this is really the highlight targets of our third industrial fund. I'm not going to read down the list there for you, but we'll go into the details of the strategy behind it and then dive into the terms in a little more detail. But big picture, we're looking to raise approximately $250 million of investor equity. That'll come from high net worth, from family office, and some small institutions. We will raise that capital while we're deploying that capital into approximately 20 to 30 standalone industrial manufacturing assets, fully occupied, with an emphasis on cash flow. So before we dive in deep, I always like to, kind of do a refresh on what is the strategy behind this, right? And our strategy is really investing capital in defensible, low basis industrial real estate that is backed by strong private credit tenants. So this is our core thesis. So you'll see here on the fundamental side, When we set these up, we'd like to buy through a strategy called sale leaseback, and we'll talk about that more. But effectively, that allows us to put in brand new 20-year absolute triple net leases. It fully shields us as managers and investors from expenses, including utilities, including insurance, including building maintenance, including taxes. All these unexpected elements we're able to shield out from our investment model through this absolute net lease investment strategy. And what that does is it really allows us to optimize around cash flow during the hold. It allows us to add value across the portfolio of industrial properties, and effectively allows us to target mid to high teens from an IRR overall return profile. Drew, if you have anything you want to add there.
No, that was great. That was great. I'll jump in here. And we're focused on a single asset class here, right? It's industrial real estate, and it's performed really well alongside, industrial multifamily tend to kind of be neck and neck for the number one commercial real estate asset class. And so we've seen a pretty steady rise in price per square foot. We've seen vacancy perform well. Obviously, a huge drop in vacancy, a massive amount of demand after COVID due to some supply chain issues where manufacturers were looking to bring supply chain sources back to the US, as well as a rise in e-commerce. Especially after COVID, of course, more and more people are buying things online. And a little bit of tick up you see in the top right graph just due to a rise in interest rates. People slowed down leasing activity while a lot of construction started to complete. And we're seeing that sort of level out and drop off now, but has remained at a pretty low vacancy rate. Typically under 7% is very healthy. And we've, only ticked up even in the current high interest rate environment to about just over 6. So we've seen a lot of leveling out there, but yes, there's a huge amount of demand and tailwinds coming from the onshoring of manufacturing. And I've had a lot of questions from investors. Hey, what happens with industrial real estate if Trump puts a lot of tariffs on imported goods? And simply put, the answer is we're doing very well if that happens, because U.S. manufacturers, which are our tenants, become a bit more competitive if they're competing with overseas suppliers. So there's quite a bit more strength in U.S. manufacturing, just looking forward into what potential changes we may see. But the underlying fundamentals, we feel that there's another 10 years in front of us at least. We don't feel like we can see too much further beyond that of strength in industrial real estate, as the need for U.S. supply chains as well as e-commerce support continues to support that. And this graph really shows that well. Huge amount of spending over the last 2 years or so in manufacturing, and some of that driven by some government incentives, tax incentives, and the Inflation Reduction Act and CHIPS Act gave some tax breaks for some qualified manufacturing facilities to be built and built out. So we see a huge amount of, again, demand specifically in the manufacturing side of industrial real estate. As you can see here, leasing volume has gone up, and the submarket or the U.S. manufacturing vacancy rate has gone way down. So again, this is manufacturing vacancy, a little different than total industrial, because it's not including third-party logistics warehouses, right? Those big boxes you see, which are typically warehousing a lot of goods that are being distributed and oftentimes delivered to customers' doorfronts, right? So in manufacturing, we're seeing even more strength than we are on the warehousing and distribution side. And again, that's where our focus is. And many of our tenants are manufacturing widgets and parts, or in food production. So they're on that side, or that sub-asset class within industrial real estate. Neil, can I pass it to you here?
Yeah. So, I mean, to piggyback a little on what Drew said, we always, before we dive into the structure in more detail, I always like, really making sure that the big picture is clear, right? Why are we choosing industrial as, an asset class for the last 8 years and in the foreseeable future to continue to invest in? So, like Drew talked about, you have the demand element, and that's largely driven by e-commerce growing, and it's largely driven by reshoring, and that's manufacturing being either expanded in the U.S. or relocated from overseas back to the U.S. All that is putting continual increase in demand pressure on a finite supply of warehouses. And really the second piece is, kind of where we are in the market cycle. So, right now at the end of Fund 2, which we closed out a couple months ago, and early Fund 3 pipeline acquisitions, we're seeing right now low to mid 8 cap acquisitions. I mean, historically, we've been at a high 6, low 7 for many, many years. So we feel like we're still in kind of an exceptional buying zone. We're able to pair with fixed rate debt. That still makes sense. We're able to get a nice yield spread between the two, which effectively equates to cash flow, which we optimize around. We're seeing lenders really come out of the woodworks. Drew can talk a little bit more about that on our lending slide, but really we're actively seeing lenders do due diligence on the same properties we are. They are bullish in the industry. They are providing really excellent fixed rate, predictable debt terms that we can pair with long-term net leases. So these really paint the picture on why we're really bullish on the industry as a whole and why we continue to invest in this. So
Thanks, Neil.
talk a little bit about inflation and interest rates. So these are common questions, right? We live in an inflationary period right now that is higher than it has been historically. Often people look at this and go, "Hey, how does this asset class hold up?" Right? And so we're protected across a lot of the inflationary unknowns. So you look at what is affecting people's bottom line in commercial real estate right now. A lot of it is insurance premiums hiking. It's repairs costing twice as much as they used to just a couple of years ago. It's utilities going up 40% because of surcharges outside of control. These are all elements that continue to happen, but we are hedged against that through the absolute net lease structure on our leases with our tenants. So effectively, our tenants absorb all those expenses. They absorb the surprise increases in those expenses and allows us to control our bottom line in a much more predictable fashion there. And then on the debt side, like I mentioned before, we're seeing debt start to tick down over the last 9 months. But our model, we effectively lock in fixed rate debt at a level that makes sense for the yield we're targeting. What happens if debt goes up? We're protected. If debt goes down, we have the option to refinance, lock in lower debt, and increase yields. So it's a defensive strategy on the debt that's served us well. And over the last 3-4 years, we've been able to protect and lock in yields and distributions across our portfolio there.
Yeah, and I mentioned earlier how we've had a very nice track record on distributions, and Latan has access to a lot of the users on Vyzer's data that really shows that, and that's a huge reason for that, right? Along with all the other pieces we're talking about, selecting deals with great credit tenants, but that debt structure over the last 2 years, we've seen a lot of real estate get into a distressed position because they can't manage the higher cost of borrowing on a floating rate loan or a loan that's very short term. Our loans are typically 5 years minimum, up to 10 years with fixed rates in place. And just to add to what we're talking about with the insulation from all the expenses there, what that means is that every time these annual rent bumps kick in, 2 to 3% per year, that's a true increase in net operating income, right? So there's a lot less variables and assumptions made in our underwriting because we can see very clearly NOI going up. We're not making the assumption on expenses, and we're not making the assumptions on increasing rents, right? This is baked into a long-term lease, and so we can see that NOI going up, which is driving the increase in value of the property over time. Neil, you want to take sale leasebacks, or I can't?
Yeah. So, our target focus from an asset class is light manufacturing and industrial. And then we have a bit of a niche specialty within that niche, and that's how we acquire these properties. So we acquire almost exclusively through sale leaseback. And to paint a picture, typically what happens is you have a privately owned private credit manufacturing firm. That firm is in the process or has recently been acquired by a private equity group who's maybe building a portfolio of manufacturing firms. When those PE sponsors come in and buy that manufacturing building, often they will look to monetize the real estate And they do that through selling us the real estate, simultaneously leasing it back. We get to dictate the terms of the lease, typically 20 years in term, absolute net lease, annual rent escalators that make sense for our yield targets. And then in exchange, that private equity backed manufacturing firm, nothing changes in the building, but now they get a full monetization influx of capital for that real estate. They're able to, pay down long-term debt lines. They're able to reinvest in operational growth, really whatever they see as the best way to grow the business and their new investment there. So that's really the underlying way that we acquire these. Lets us put in honestly top of quality industrial or excuse me institutional grade leases, and lets us maximize the term on those leases, and allows us to position ourselves in the strongest landlord position, in our opinion, possible in the industry.
Yeah, and I'll jump in here, Neil. Just dovetailing off of sale leasebacks is really the opportunity and the opportunities that come through our pipeline are often stemming from our experience in sale leasebacks. So the brokers in that space know us very well. They know our target buy side, and we have a reputation to be able to close on these properties. So while we look at widely marketed properties, we often get opportunities that are very selectively marketed to a small group of buyers who have a reputation for being able to execute on what is a little bit more sophisticated transaction, right? We're not only negotiating the PSA, right, the sale price, but also the lease terms. And oftentimes that's where there's a lot of nuances, especially when you're dealing with a corporate entity that has, they're a sophisticated group, and they certainly want to make sure that in a 20-year commitment, it's very clear and everyone's in agreement. So we look at a huge amount of deals, though, in our pipeline, and every year, we close up a folder. 2023 had over 1,000 deals that we had looked at it, and we closed on a very small percentage of those, less than well below 5% of deals that we've looked at. So you could see this graph on the left showing really that process, whittling it down to, again, the best deals across the country. And oftentimes, we walk away from even deals we think are very good, but ultimately we have to focus on what our capacity allows us to. So again, those broker relationships are important. And Neil mentioned private equity groups buying these operating companies and spinning off the real estate. A lot of these relationships are built with those groups as well, as they continuously are, using that dry powder and acquiring more operating companies. They're looking for partners on the real estate side, and we've been able to offer them additional real estate services, whether that's, hey, we can help you with a build-to-suit project to expand one of these operating companies, or continuing to be a buyer on sale leasebacks in future acquisitions of companies, right? As long as, of course, we're comfortable with the credit of the tenant. So there's a lot of relationship that's been built over the last almost 10 years. And so that's been hugely beneficial for us. I mentioned expansions and developments. I think sometimes people look at what we're doing with net lease industrial real estate and say, you're just clipping coupons and there's nothing more to it. That's a great basis for sure. We're cash flowing at a really healthy rate, generally north of 7%. From day one to LPs when we close on these. But we look for opportunities to add additional value where we can. And as these companies grow, especially with the sophisticated private equity sponsor and additional capital there, we see them grow organically, and oftentimes they need more space. So again, we can be a real estate partner for the tenant and say, look, we can finance and manage a development of an expansion for you, whether it's 50 or 100 or more thousand square feet, and at completion we'll strike a brand new lease with a new set of term, inclusive of that, including rent. That's usually around 10% of construction costs, so an effectively 10% cap rate on that addition that we've added for them. So there's a lot of additional value you can bring there, and we see even more returns when we sell the property down the road. But there's also other ways to add value through contractual lease value, right? And having a 20-year net lease, there's a lot of value there already, and we've executed that in the beginning, and we've created a little contractual value there. But sometimes we see opportunities, if there is one, with a lease in place. Hey, can we work with the tenants? Maybe we can give them some TI dollars, some CapEx dollars in order to extend the lease term, or convert something from maybe a double net or triple net lease, which doesn't include everything, right? It may not include roof and structure, and convert that to an absolute triple net lease. So we see sometimes there's some arbitrage there if we're able to convince the tenant to do that. And it might require some investment in the property before doing that, but the value of the property is heavily tied to the lease structure, with the tenant and the credit standing behind it. Anything to add to that, Neil?
Yeah, I mean, really, we model these in the way that we know our future buyer will be looking for. So, often, we're selling to REITs, to, income-focused institutional groups, especially on the fund level. We can package all these properties together and sell them as a portfolio. Those groups are going to be looking for annual increases that are baked into the contracts, to the lease contracts, that show increase in NOI year over year. So to Drew's point, if we can modify those leases, extend the term out, and provide that very predictable contractual increase in NOI year over year, that provides a premium and really strong alignment to our future buyer.
I'm gonna, just to keep time available, we have some materials we could share with interested investors, but this is kind of a comparison chart to show how we sort of stack up and compare to other groups out there. But I think this is more important to spend some time on, which is risk mitigation. How do you mitigate what is ultimately a very concentrated tenant, a single tenant default risk? We talked about earlier, insulating ourselves from the operational expenses. We don't have risk around expenses going up, or day-to-day leasing activity, or occupancy rates floating up or down. However, we have a single tenant, and like Neil said, it's a binary rent profile. So we focus heavily on there because really the risk is that they default on their lease. And so we spend a lot of time, and again, have built our team around credit analysis, and we dive into the credit of this business, which again, these are typically privately held. So in a sale leaseback, we get their cooperation and access to their financials. We're going to spread those numbers. We're going to look at those really closely. What's important, of course, is how well are they covering rents by their own profit margin? What kind of debt do they have on their balance sheet? What are the covenants there? We get into heavy detail. Our credit team actually interviews the entire C-suite to really understand the business and understand where they intend to go in the future, what they intend to use the proceeds from the sale of the real estate for, to grow the business going forward. And of course, looking at some high level pieces, what is the industry that they're in? What's the landscape look like? What's the future hold? What risks are there from that industry? And then what's the competitive landscape? Where do they stand? And what kind of headwinds do they have there? But we're also looking at the specific location's profitability. So some of these tenants are single location, right? And that's great. We hold a primary asset that's crucial to their business that they cannot operate without. But some of these tenants also have other locations. So we look at maybe a 6-site operating company, and we're buying one of them. We would like to have the headquarters or the main manufacturing site where most of the revenue and EBITDA, the earnings there, are generated from. And there might be several that are generating earnings. We want something that's absolutely crucial to that organization, so that if they ever do get into trouble, if they ever do have a rough year or quarter, that they're never intending on vacating this property because it's so important to the organization. And finally, beneath all that is really what the investment is in. It's in the real estate, right? So we have this collateral here, regardless of a tenant or not. And we're really focused on how defensible that is, and how close to what they call the dark value is, meaning a vacant property like this. What does that trade for? We want to be right at about there, because then if we do lose a tenant in that very unlikely scenario, we have an asset that we can trade out of, or potentially release with a new tenant at maybe higher rents, right? Depending on where market rents are. But we're talking about basis here, but rents are also important, where we want to structure this new lease with our tenant at or below market rents, so that if we do ever in the future need to bring in a new tenant, we have an attractive offering to a new potential user of that property. I'm going to, do you want to talk about this, Neil, or fly through it?
Yeah, we'll kind of fly through, but I mean, ultimately, what are we buying? It's typically continental US domestic industrial real estate. If you can imagine upstate Michigan down to South Texas, that line probably incorporates about 85% of what we buy. So really in that kind of manufacturing Midwest hub. The type of properties, I mean, these are going to be metal boxes, more or less, four walls and a roof, as we like to joke. They're going to be steel-sided walls, typically flat roofing. Inside, you're going to have a couple of 5, 10, or even 20-ton cranes. But aside from that, they're fairly agnostic properties. So we don't do heavy manufacturing. We don't do life science. It's very agnostic, reusable types of more or less steel boxes that can accompany a huge range of different tenants. And that's by design in case we ever did need to release there. Tenant credit, Drew just talked about that. But in general, we kind of target $50 million a year in sales or more, strong manufacturing margins, which in our space is, 8, 9, 10, 12%. And then debt, we want to make sure that our tenants have a very low, manageable corporate debt load. So on the leases, we've talked about those ad nauseum. Those are the contractual power behind the yield that we're seeking. And then lastly, what does the overall scope of the fund look like? For Fund 3, we're looking potentially 30 to 50 properties. So each of these properties by themselves are, typically 10 to 50 million. About $15 million a piece is sort of our sweet spot, which we end up buying a lot of. And then you can see here our target acquisition cap rate is 7% plus. In today's environment, we've actually, most of what we're seeing is either high sevens or low eights, which we feel is very good, especially from a historical standpoint.
We should
talked
sort of
about that.
streamline through this just because we are at half the hour and we want to leave some time for questions. So like you guys can, let's just focus on the meat and then get the questions.
Love it.
Absolutely. Yeah, we have a lot here that I think we can go through, but let's get to some of the terms here. Neil, do you want to give us kind of a quick overview of the terms, just high level, and then we can get into questions?
Yeah, absolutely. So right now we have there's a bit of a spread, but ultimately the terms are going to be a similar structure to what you've seen. An 8% preferred return. There's a 80-20 split after return of capital and a catch up there. We have a direct and a REIT feeder, and this is kind of important. The direct will have flow through depreciation. You're investing directly in the fund. The REIT feeder, it's a 100% pass through model, so there's no change in economics. However, from a tax basis, if you're investing through retirement funds, or if you're sensitive to multiple state tax filings, the REIT will fully eliminate all that, and so you only have to deal with it on a federal basis. And we can talk in more detail there if anyone has interest. You want to go next slide? And then from a fee structure, we feel we're pretty competitive in our space. On the front end, 1.25% acquisition fee on purchase. Management fee ranges between 1.5 and 2 based on what the ticket size is there. And then really no other fees beyond that. So it's a very kind of lightweight model. And all in, again, we're targeting, roughly about a 16% IRR across a 5 to 6 year hold on this fund. So that's ultimately what we're balancing: yield, cash flow during the hold, and then profit generated upon disposition, to really seek that target, which we've shown we can do over and over in the past.
Sure. I'll just mention distributions and reporting are done on a quarterly basis. And we also have the fund fully audited by our partners over at Ampner Eisner, which is a large national, very institutional financial auditing firm. And quick look here, we have several different investment classes. They're all sitting as equity in the fund, but they have different, what we'll call it preferred economics as ticket size goes up, as Neil said. So Latan had mentioned in SPV, if that SPV that people participate in get into a higher dollar amount, that certainly would participate in better terms here. So something to keep in mind here. If you're looking to write a larger check, you can certainly participate in a lower management fee and a higher preferred return and a better split above that. And as a bump or a bonus, we're giving all investors who commit before the end of this year a bump up to the next class. So if you're investing $100,000 into the Fund 3 REITs, you would be bumped up to Class A2 and get a reduction in fee and a bump up in split and preferred return. And I'll just, there's a couple examples here, but Fund 1 and 2 are cruising along very nicely, on average, cash flowing a little over 7% there. And each of those having north of 20 assets in each, just like the assets that we've shown you previously in our strategy. So this is really Fund 3 is a continuation of the same strategy. And instead of going here, I'm going to maybe keep it on this slide and let Latan MC questions if you'd like for us. Or if you want to open.
I do. If you go back to the slide of the different share classes, and I'll just touch on that in terms of the SPV. So as I mentioned at the beginning, and for those who joined a bit late, Vyzer is also investing in this deal through an SPV we're putting together for our own shareholders who are investing, and we're doing that SPV. It's like no cost, no fees, no carry, nothing, just to provide pure value to our user base. And that SPV will be a minimum of 50,000 to invest. And based on the amount of money we get into that SPV, we'll be able to reach the better terms, hopefully. But again, there's no incentive here. Like whatever you guys want, if you guys want to invest direct or through their own REIT, that's fine. But if you want to do it through the SPV, it's also fine as well. We're just doing that so we can even provide a lower minimum to this deal with no fees and no costs at all. And again, that bump will also, I guess goes to that as well, right? If that SPV is more than $1 million, then we're bumped up to A4, correct? That's what you're saying, Drew, right?
Correct. And
right.
A4 is really institutional terms. I mean, these are the best terms, you're going to see. And this is what a public pension fund, would be enticed by, right? Would be getting through writing a large, 10, 25, $50 million check. So very good terms if you can bring in a million plus commitment before the end of the year. But even at A3, you're still at a very competitive terms when you look at the landscape of the market and other funds and those terms. And I will say really quickly to the attendees here, that's a very generous offer by Vyzer. Normally, someone structuring an SPV would take some kind of fee. So the fact that you're not is there's nothing you have to lose there, frankly. So that's a generous offer that I don't think I've seen by anyone before. So if you're wondering if that's a good idea, that's if you like the investment, that's certainly not a bad idea if you don't have $1 million to commit.
Now, all right, so we have one technical question and then maybe dive into the meat of it. Number one, how long is the raise going to be open? Like how long are you raising for this fund? And is there an option for reinvestment of distributions?
Yeah, I'll answer that.
Yeah. Go ahead, Neil.
Yeah, so Fund 3, right now we're taking commitments. Initial closing, the first asset and the initial call in of capital, we're targeting for mid-December right now. But we anticipate Fund 3 likely to be open the better part of 2025. So we're thinking kind of 8 to 12 months, just based on the demand and how it's received there. And then what was the follow-up question there?
And if people want their distributions to be reinvested, is that possible?
Unfortunately, we don't have an automatic reinvestment. However, we do allow multiple positions within the fund.
But at the same minimums? At the same minimums?
Once you've hit the minimum on the first one, it really doesn't matter what you come in on subsequent. It's just like an amendment to your original subscription agreement. So we're more than fine with adding additional funds to your position through the life while we're raising capital for that Fund 3.
All right. Another one is the IRR quoted? Does it include tax benefits of depreciation?
Does it include tax?
It does not. Yeah. No, I think what the question is that sort of are we taking tax benefits assumptions and adding that to the IRR? No, we're not. So that is a 15% IRR target that is not inclusive of any kind of tax benefits.
Yeah, it's a levered IRR, so it incorporates the debt we're putting on the properties, approximately 65% LTV there.
Okay. And we have a live question here. Let's allow Mike here wants to ask a question. Yeah, go ahead, Mike. You're on mute if you want to ask a question.
Okay, thanks, Latan. Hey, a couple of questions. So how long, I guess $250 million raise, I was initially thinking would be a multi-year. So you think you can get that done in 8 to 12 months? What was the time frame on Fund 1 and 2? And what's the longest that Fund 3 could go? So we just know kind of what it could lock into as far as if we're investing now, when would the last money in be?
Yeah, I'll take that. I mean, really, that target is assuming some interest we have that we've been working with some institutional partners plays out, right? So there's a number of guys who've been looking about 25 to 40 million kind of early seed investments into the fund, which would expand it accordingly. If those don't come to fruition, really doesn't matter. We'll keep the strategy. We could limit and basically close it out early. But big picture, we're not necessarily tied on the 250 so much as we are, roughly 8 to 12 months of raising capital.
Okay, great. Yeah, I like to be into things that aren't super long. If they're multi-year, then I want to look at how, is the NAV going to increase or something like that.
Yeah.
Latan,
I don't have the
related,
attention span for 2 or 3 years of the same product. So
yeah, related to that, Latan, like they said, I've never heard of anybody doing an SPV for free. So that's an amazing opportunity that you guys are offering. Are you going to allow members to, kind of come in through that time frame? Because I mean, there's a huge benefit to us with you being in now where you get that stepped up amount. Are you going to be, is this something that you're closing down your SPV fairly quickly and we have to do it before the end of the year? Or, does yours get started and then it's sort of an evergreen through the raise period for
No,
Fund
yes,
3?
that's a great question. No, I mean, I haven't put a date on it yet, but it's definitely going to close by the end of the year.
Okay.
It's only for this. It's a one-time investment. We're not going to do anything else with this SPV. We'll probably do another SPV for other deals we do, but that's the objective of this. So it won't be open.
Okay. Yeah. Well, just getting to the A2 is some really good splits. And then certainly if you can get over the million to the A4, that's phenomenal with both fees and things that way. The other question I had for you guys is, so I know the past funds have averaged about 18% IRR to investors. You're targeting 16 now. Can you, so you're buying things at stabilized 8 caps. Some of those you're going to have the ability to do expansions, and the expansion, because you don't have to add more land, you're getting approximately 10 caps on those. And then the third part I heard was that because of the roll-up structure, if you're able to exit a larger portfolio to private equity, that's probably going to give you an extra, 0.5% in cap rate reduction or something. But is there anything else that gets you to that 16? Like, what's the rest of the value add? Because those don't add up in my mind to a 16 if you're in a stable cap rate environment where the exit cap rate is equal to entry as far as overall market. But what have you done for assumptions on exit cap rates versus entry, and how do you get the rest of that to get to a net 16?
Yeah, no, it's a great question. As far as a blended acquisition cap rate, some of that with some add-on development pieces, like you mentioned, we're expecting somewhere around mid eights. As far as disposition, blended cap rate right now, I think we're modeled at like a mid sevens or a 7.7, somewhere in there.
7.
What is it, Drew?
It's a 7-8.
Okay. And so that there is some expectation of cap rate compression based, into a little more into a normalcy realm there. And then the other piece is the yield along the way. That's driven by the spread between acquisition cap rate and fixed interest rate. So really, we're targeting 150 to 200 basis points of positive leverage spread there. So, for example, if we average 8.5%, we're going to seek to put in debt between 6.5% and 7% fixed rate. And then as cap rates compress, maybe over the next year, we'll expect interest rates to come down correspondingly to keep that same spread.
Okay. And since my equity in is going to be about 1/3 of what the leverage would be, I'd be picking up 2 times that that delta to add to my amount. So that'd be maybe another 300 basis points that I would get. Okay. And then cash, it looks like 1 and 2, you're in the high 6 to low 7s as far as what you're paying out. What do you expect Fund 3 to be along the way? And like, when would we see that start? Since the first property is going to go in maybe mid-December, when, if we're an investor, say, 2 weeks from now, when would you get, or it gets called in December, when would you guess that we'd see cash flows? And what does that look like over the next 2-3 years, as far as if you were guessing?
Yeah, so we're seeing initial cash flow 6 to 8%. During the fill-up period, there's always a little bit of choppiness, right? So we have a mechanism for Fund 3 where you can either fund in tranches, which works for some, for SPV, probably not as optimal. The other option is to fund in full, and that funding goes into a high yield savings account and escrow. So your money's working, and then automatically, as the fund effectively calls capital in tranches, it pulls from that escrow account into the fund. So you're getting paid from two buckets until all of it is fully moved over to the fund there. And so that would be over the course of, the first 10 months or so. So the first year, probably averaging around 6%. And then as we stabilize, somewhere at 7% plus, and then work upwards from there as the rent escalators kick in.
Just great questions, Mike. I do have a question on that then. So the capital calls, there will no, you're calling all the capital at once, or only upon acquisition?
Yeah, we have the option. You can either allow us to call capital in tranches, kind of as needed through the, we'll call it the first 12 months of the fund. Or if it makes more sense, you can fund in full, and then effectively uncalled capital will sit there in a high yield savings account. Right now it's making about 4.5%. And that would basically sit there. Any money uncalled would make 4.5%, and then we would kind of move it over automatically as subsequent capital calls happen.
All right. Mike, any other questions?
Nope, that's it. Thank you.
All right. Just one more question here about the SPV. So the SPV, I will mention this, the SPV is limited to 25 people, and it's open to anyone at the moment. Maybe next time we might only do this for Vyzer clients, but this is our first fund that we're doing this with. And so we're going to open it up to anyone. So to that question, now there's some other questions that aren't just like technical, more about, and I think you answer this, but the target cap rate for this fund, and what was the lowest one you've seen over the past years that you've done?
Yeah, I mean, it's the market moves, right? I think in 2021, the lowest we bought was maybe about a 6.5, and then the market started compressing down to low 6s, high 5s for the type of product we buy, and it stopped making sense. So we sat out. We didn't buy anything for about 7 months there. And as you saw, the market was pretty frothy then. In 2022, it started correcting, and then we started seeing cap rate expansion into over the last 2 years into the kind of environment we are now, which is low to mid 8s. So I would say those are kind of the outer bounds that we play in.
Great.
Yeah,
Now, sorry, go ahead.
Really mentioned some of the seed assets in Fund 3 that are identified. They're ranging from about 7.8 to 8.5% cap rates. And the 7.8% cap rate one is, it's just on the outskirts of New York City Metro there. So it's a really nice location. It's really solid credit. So, we're not afraid to acquire something, even if the yield is a little thinner, if we see a really nice risk reward ratio there. But yeah, the other assets are, I think, 8.25 and 8.5 out of the first 3 that we've identified.
All right. And there's a question sort of like, and we can maybe touch on this in the end, but just like there's a question, let's keep it in the air. Like companies like Fort Capital that failed, and you guys know Fort Capital? Probably know them, right? And they failed.
Yeah.
And others like them in the past 12 to 18 months. If there's anything like you can touch on that, like why that happened and why you guys are positioned differently. And then we'll move on to some other questions here.
I don't think I know enough about
Yeah,
Fort Capital,
I don't know the
what
reason
you're talking about.
of failure there.
Yeah, well, I mean, overall, your competition in your market, what differentiates you guys from making better decisions and position you in a place where you're not prone to fail and you're more resilient than those?
Drew, why don't you pull up that competitor slide?
Yeah, but those are like tier 1, the Blue Owls and of the world. Like those are, unless Yeah, I don't know. Well, I don't know store capital in those either, but
Yeah, I mean, it's a range, right? We play with some private shops, some much larger, and Blue Owl's probably the largest, from a size standpoint. But really, most of the shops we play against require vertical integration, require a full credit team, and there's not a lot of small shops that have that ability or willingness to invest in that talent, right? And so because of that, there's very few shops our size who play in this space. We're definitely on the smaller side. We really excel in opportunities when the markets are shifting. So when you see uncertainty in the market, our experience has shown over the last 10 years, a lot of our bigger competitors will sit out, right? And they'll go, hey, we're just going to see where this goes. In those spots, in those times, we've been able to make some of the most compelling acquisitions, we've ever made from a historical basis. Dax likes to say we play in the seams, so we can be creative, right? The larger you get, the smaller and tighter your buy box gets. We might say, hey, this deal is great. Maybe the yield is a little low, but instead of putting in 2% annual rent bumps, maybe we'll do 3.5% for the first 5 years. That'll still get us to where we want to be. That's a way we can be creative. Maybe the tenant's a little smaller, right? And you say, hey, I like their financials. They're a little bit smaller. They're only doing 30 million a year in revenue, but maybe I can, for example, withhold 6 or 12 months of security deposit. And then once they hit a certain financial metric, then I'll release 11 months of that, back to a normal 1 month security deposit. So these are ways that we can be creative, feel like we're still providing a nice risk-adjusted return, but be able to win deals that, some of our larger competitors won't look at.
I want to try and answer some quick questions here because there might be some take longer time. So you mentioned cost segregation. You will be doing for properties, and the tax benefits will flow through only if you do the direct investment in the fund, not the REIT, correct? Just like high level.
Yeah, so passive losses, excess losses only flow over from investing directly in the fund versus the REIT.
Right, and also through the SPV, same deal. The SPV will be treated like the REIT. Okay, so we did that. And when do distributions start after investing?
The first quarter.
In exit strategy, is it similar across all assets, or do you have for each deal you guys make, is there a different type of exit strategy for those deals?
The preferred strategy will be effectively line up a bunch of 20-year leases, hold for 5 or 6 years, and effectively sell as a portfolio with a WALT, a weighted average lease term of roughly 14 years. Sell the entire portfolio sell the whole fund as a portfolio to a larger REIT, to a sovereign wealth fund, life insurance, pension fund, a number of different larger buyers like that as the preferred exit.
All right, cool. Now some deeper questions, I guess. So you mentioned the exit strategy. Can you share more about what drives the IRR, just high level, and is it more rental income? Is it profitability on the sale of the property? What drives the IRR?
Drew, you want to take that?
Yeah, absolutely. It's coming from a few different factors. And I did want to chime in earlier when Neil was talking about cap rates and assumptions on sale. It's important to note that when you're buying on a sale leaseback, typically we have an edge on that acquisition, right? This is not a leased in place asset. So what we see in the market, assets with leases in place that are seasoned 15 plus years, typically trading about 50 basis points lower in cap rate on the front end. So, I mean, I would summarize that by saying we're creating some contractual value on the front end by executing an institutional grade lease with a very creditworthy tenant. So that's one piece. The other is rent growth, right? And not just rent growth, NOI growth that's baked into the lease and structurally protected within that lease. So we see that again, 2.5%, 3% rent bumps or NOI bumps per year. And then over time, we're using amortized debt. So we're paying down debt along the way. And then, of course, across a larger portfolio, we're going to see some of those opportunities that we mentioned to add value, right? Whether it's an expansion, whether it's even capitalizing some CapEx work for them in trade for higher rents, right? The tenant's responsible for a roof. We might say, hey, we will trade a roof replacement for, $100,000 more a year in rents, bumping you up 10% because, hey, we're below market rents anyway. So there's some of these opportunities that we we see here and there, and I think Neil and I have calculated down about 1 in every 3 or 4 deals that we do over the course of a 5-year hold, we see some form of opportunity to add additional value there. So you put all those together, and that's how you start getting up there. But yeah, cash on cash for an LP, you're going to say, okay, let's say I'm averaging, 7.5, 8% over the course of this fund in cash on cash. That brings in about, I think it's about just under half, about 45% of your total returns across those 6 years that we're targeting to hold for. And then the rest of that projected return, about a 2x equity multiple, is coming from profits on sale. So hopefully that kind of outlines it well.
All right, last question here, and then we're going to sign off here. But there's a question here about if the OPEX increases, then triple net will fall into rent. Or you guys see this question in the Q&A? Ultimately, on renewal, that will hit rental rate bottom line. In addition, if that happens with rates rising, are you concerned about getting the investment getting impacted or wiped out? I'm not really sure I understand the question. Maybe you guys understand it better than I do.
I think if I'm reading between the lines, I think there's saying, hey, if a tenant's, expenses are going up, and basically, yeah, maybe like, how do we work on making sure that we're not overstressing our tenants? So I think a lot of that is really starting with a sustainable rent level. So we try to model what we call lean sale leasebacks. So sale leasebacks can be bloated, meaning you pay a lot for the property and they'll rent it back for a high rent, or lean, which we target. And that means we want to pay on the low end for the property and we want to lease it back below market rent. That's good for a number of reasons, but one of the main ones is we're not overstressing our tenants. In the event we do lose a tenant, we have upward mobility to release at market. And then ultimately, we're still able to get that yield we're looking for, and the tenant's able to, not get overburdened by their rental obligation. So these are our credit guys are really, they will forward look, they'll pro forma, hey, after this transaction, what is their set of, fixed cost coverage ratios? What is their rent coverage? And these are all metrics they look at to make sure that the tenant is, in a position where they can comfortably cover it.
All right. Okay.
I'll mention really just to add to that. Sorry. Typically, and when we look at the credit, I'd say on average, the profit of a company, of our tenant, is usually 5 to 6 times higher than the rent obligation. So there's a lot of buffer there.
All right. This has been great. Super interesting, guys. Thank you for sharing this. And for anyone who's interested in the SPV, because there were a lot of questions about that, don't worry, we'll reach out. We're going to share this recording with everyone after the call. We're going to share your information if anyone wants to invest directly with you or with us, through us into the SPV, and share all that data. Can we share the deck also, Drew? I'm going to share it with the recording after the call.
Yep, absolutely.
Awesome. Thank you so much for joining us, everyone. Drew, Neil, thank you for presenting the deal. And yeah, man, hopefully until next time, everyone keeps investing wisely, and we'll be in touch. Have a great weekend. Bye, guys.
Thanks, everyone.